I'm Merrin Somerset-Webb. We're here today to celebrate two rather exciting things. First, the anniversary of the launch of Blue Whale Capital, and second, the fact that the fund, which now has an excellent reputation thanks to its very impressive performance, it has £1 billion under management in its LF Blue Whale Growth Fund. So I'm joined today by Peter Hargreaves, Chairman of Blue Whale, and Stephen Yu, who's the Chief Investment Officer of Blue Whale Capital and Lead Manager of the Blue Whale Growth Fund. Welcome, both of you. Thank you. Today I'm going to ask them quite a lot of questions submitted by you, the investors in the fund, about the things you really want to know about the fund's performance, about the team's investment process, about the various stocks held in the fund, and we're also going to be digging into their thoughts on the wider investment landscape. Now, the last 15 minutes of this, we are saving to answer any questions you might have for Stephen and Peter today that you haven't already asked, and you have asked quite a lot of questions already, but anything else you have, please use the chat function of the app to submit them in the next 30 minutes. So we'll take questions for the next 30 minutes, and after that we'll try and get through as many as we can of them. So the more, the better. If you'd like to review the Q&A session, a recording is going to be available to everyone who signed up to join us today, so you can watch it again later. Finally, I want to remind you that this Q&A session, is intended for UK residents only. Right, let's get going. So the first thing I want to ask you, both of you, and let me ask you first, Stephen, you've done this before, you've done these Q&As before, and I've watched some of them. Why do you do them? You're very busy, the fund is doing well. What's in it for you?
Yeah, thank you for the question. I think one thing that we have been quite passionate about when we first started the business is to be quite open with our investors. Mm-hmm. And I think having this Q&A session is really to share our thoughts. If people have any questions about the fund's holdings, about the market, how we see things, I think this is a good way to communicate with our investors. So we have tried to do this as regularly as we can.
Mm. And Peter, you're joining today. This is the first time you've done one of these Q&As for the investors, right? Why have you joined today?
Well, when I ran Hargreaves Lansdowne, I always felt it was quite important on occasions to meet clients, how they thought, how they invested, and again, this is exactly why we do it. The feedback we get from the holders of the fund is invaluable in our communication with them ongoing.
Mm. Okay, that makes complete sense. Right, so let's get on to the questions that your investors are really interested in. So the first thing to say is that the US market, which is where you're mainly invested, is known to be extremely expensive, not far off historical highs on pretty much any valuation you want to look at, right? So everyone is now worried. Will there be a correction? Will there be a crash? How sustainable is this? Stephen, are you worried about this? Do you look at your portfolio and think, oh my God, this could be down 40% in a month?
Yeah, I think that this is a very big question because obviously if you look at the composition of the fund, we invest into the best of 25 to 30 names, which we deem them as superior quality businesses. And we would try to invest and hold those shares at a very attractive valuation. Mm-hmm. But I don't dispute the fact that the rest of the stock market, especially in the US, there's probably some sort of like a mini bubble somewhere. I mean, there's been a lot of loss-making businesses trading at an extreme valuation. There's some really cyclical, low-quality businesses that are trading at a very premium to the historical high. And I think what is probably been supporting the market is low interest rate, quantitative easing, etc., is probably likely to change going forward. And what we think is likely to happen, obviously, if there's some sort of correction in the market, our shares would get sold off at the same time as the rest of the market. But given the quality of the business that we have in the fund, they should recover much quicker than the market. And I think one thing just to remind our investors that the recommendation holding period for a long-only fund such as ours is about 5 years. And if you do have a medium-term horizon, that we should be able to deliver good returns. But if you really worry about the next 6 to 12 months, I think that's a very difficult call to make.
But there's no way really to protect yourself from this kind of thing. If the market starts to fall, this fund will fall too, and there's no particular way to protect yourself in the short term.
Yeah, I think there's some things that we can do, but it's definitely not. I mean, firstly, this is not absolute return fund. Mm-hmm. So if the stock market is going to go down 20%, I mean, it's likely that we will lose money. But if I look back to the period back in 2018, when the Fed was trying to raise rates in Q4 2018, and the stock market was down about 5%, and this fund was up about 8% in that year. But obviously, that sell-off was quite minimal. It was only 5%, not 20%. So I think on that note, it depends on how you see things. I mean, we have been actually raising a bit of cash in the fund just to be opportunistic in terms of if there's a correction, we might be able to invest more into the shares at a more attractive valuation. But yeah, I think just to caveat that, I think investors need to take a medium-term view rather than a short-term view.
Okay, but raising cash, and this is interesting, Peter, you have long experience in markets. There's this idea that if a market is very overpriced, there'll be some kind of trigger, some kind of catalyst for a correction or collapse. And if you're raising cash at the moment, maybe there's a suspicion there is some kind of trigger out there. Would it be monetary policy? What would it be, do you think?
I've always said when there's a lot of worry about a market, that's probably not the time that it's going to crash. They always say a market climbs a wall of worry, and I think that is true. It's when everyone is bullish of the market that it's time to worry. And the thing I think that is quite important is I know investors who have thought the market was high and they don't invest, and then it goes higher and they don't invest, and they're still waiting after 10 years. And so I've always said, if you've made up your mind to buy something, buy it. Because as you continue watching it, you'll find lots and lots more reasons not to buy it. And if you want to buy, and at the end of the day, with all investment, it's time that is more important than timing. And, I'd be quite happy to put market money in this fund right now. I have a very large holding and I'm not thinking of selling any. So it's a difficult one, but that's something that all investors should remember. It's time, not timing.
Okay. Well, let's look then a bit more at the fund. And one of the things you just said, Stephen, is that there are areas of the market that are bubbly. And a lot of people say this at the moment. If you look at the US market, it's driven by bubbles in different sectors as opposed to driven by bubbly valuation across the board. But one of the things we might say about your fund is that it's very, very tech heavy. And you could also say that it's in the technology sector where the real bubble is. So is that a concern? Or would you say this isn't really a technology fund, it's something else and we're looking at it wrong?
It's not a technology fund. It invests in businesses that make the best use of technology, not new technology, existing technology. I mean, Amazon is not a technology fund, a technology share. Amazon is just the world's greatest retailer, and it uses the internet to the greatest advantage. And many of the other businesses are the same. They're not bleeding edge technology. What they are doing is they're making maximum use of the technology that's available, especially the internet, which of course we've seen boom during the COVID crisis. And people are going to stay doing business the same way. The world has changed. I hope it hasn't changed so that people isolate themselves, but in general, the world has changed, and the businesses that have embraced these new technologies will persevere.
So you could say that pretty much every successful company is a technology company and isn't a technology company at the same time. In that success at this point means that you're using technology properly, that you're digitalizing, etc. So there's no such thing anymore as a successful company that doesn't have a technology edge.
You only want to invest in scalable businesses, and the only businesses that aren't technology aren't scalable. They're professional services where it's one-to-one, and of course they're very, very difficult to scale. I mean, the only way you can grow them is to double their employees, and of course that's not where you want to invest. You want to invest in businesses that can double their business and only increase the workforce by 5%, and that's what technology does for you.
Yeah. Did you want to add anything now, Stephen? I see you nodding away.
No, I completely agree. I think on a really high level, I mean, on one side, if you look at our top 10 holdings, we have the likes of Adobe and Microsoft. I'm sure a lot of people are familiar with them now. But then on the other hand, in terms of technology businesses, I mean, we do have a lot of everyday life tech companies, we call them, like Amazon, Google, Facebook, using WhatsApp, etc. And I think it's just a bit of like a misconception when people talk about a tech bubble. And I think from our perspective that we do see many companies within the tech sectors that we would never be interested in, like Uber, Airbnb, even like Tesla, Netflix. I mean, we deem these companies as very low quality. So I think, if on the other hand, if you look at the valuation, they're probably trading quite expensively at the moment, so we just want to avoid them at all costs.
And you do. They're definitely not in the portfolio, are they?
No, they're not.
Okay, so this has been an incredibly successful strategy so far. So since inception, you've returned, 114% against a global average for this kind of fund of more like 60. So that comes out at just over 20% a year, which is absolutely extraordinary and very impressive. Congratulations. But can you continue to do this? And can you continue to do this without moving into, say, markets that look less expensive? So if we look around markets as a whole, you're very US heavy, for good reason. Obviously, that's where a lot of the innovation is. But there are other markets that look on the face of it significantly cheaper. So Japan, the US, emerging markets, etc. Is it possible for you to sustain this level of outperformance, do you think, while remaining so US focused?
Yeah, I think on that part is obviously over the last 4 years we did relatively well, and if you look at the analyzed outperformance relative to the market, is about 8% net of all fees, and then on an absolute level we analyze at 20%. I think one thing just to be very clear that we are very conscious of valuation. I think not only that you want to invest in great businesses, but at the same time you want to pay the right price. I think at where we stand today, there's still a lot of names that we have in the fund that we deem the valuation to be very attractive, because the way that you deem it to be quite attractive is because the earnings growth trajectory over the next 5 years is not going to be impacted by any macro uncertainties. Like if you worry about COVID, if you worry about the politics, you worry about what's going on in Asia, etc. I mean, most of our companies are quite immune from them. So you can actually have a bit of certainty they will be able to meet or exceed the targets. And then at the same time, if you're going back to what we are trying to achieve here, is we aim to outperform the market by over 5% a year over the medium term. And I think the market has been pretty strong for the last 4 years. I'm not sure whether it's going to be as strong in the next 4 years, but if we're just referring to outperformance, I think we should be able to continue the trend.
Yeah, anyone hoping for 20% a year indefinitely would be possibly over-optimistic.
That's right, yeah. So it might be lower than 20%, but we still would be able to do better than the market.
Yeah, thinking about the markets that might look better valued at the moment, Peter, I don't know if you have an opinion on this, but there are lots of interesting, innovative companies, say, in China, and I don't think you have any Chinese stocks in the fund. And would you? Is that an uninvestable market now, or an area where if there's something innovative and exciting, it would be worth going?
I think the worry about China is getting the information that you need. And also, you've got to remember, it is not a democracy. So, the government can interfere in a major way with what could happen there. And I think you've enough worries in investment without worrying about political interference with companies. And the big worry in China is the property market there. It is huge. It is heavily mortgaged, and anything can happen which could destroy confidence. And Xi has made these comments about not wanting people to get too rich in China, and saber rattling of that nature. And it's that sort of uncertainty. The one thing that frightens a market most is uncertainty, and I think. It's early days for whilst China's economy has been phenomenal, it's still not been an easy place to invest. I think you've had to be an insider really in China to make that work.
Yeah, would you agree with all that, Stephen?
Yes, we do. We do not have any direct investment in China as we speak, and I think it's just about the certainties, the level of disclosure, transparency, corporate governance, and all that. And now we have another additional layer of uncertainty on the domestic policy. So we try to avoid any uncertainties as far as investment is concerned.
It's hard to find any area where there aren't uncertainties at the moment. You said earlier that there were lots of things that you could worry about. What is the thing that you worry about most on a macro level? Do you worry about, for example, inflation?
We are actually not worried about inflation, because I give you one simple example, is like Microsoft being a top 10 holding in the fund since we started, recently, a few weeks ago, they announced they're going to raise the prices for the subscription of Office 365 by 15 to 20%. And that's nothing to do with inflation. And obviously, this company is $2 trillion to start with. It's very big, it's very successful. And as a professional user of Office 365 through Teams, through Outlook, Excel, I mean, we're just being stuck with paying them more money in the next few years. And I think as far as this company is concerned, I mean, it's growing the top line by over 10% year on year. There's no input pricing pressure because most of them is software and people, and I mean, their gross margin would be close to 90%. And so inflation is not going to affect them. But I think on the other hand, if you look at even some traditionally good businesses like Unilever, they recently reported they are seeing margin pressure because of the rising oil price, etc. And at the same time, they're quite worried that if they raise prices, the consumer like us might be going to other brands such as supermarket-owned brands or maybe P&G or Nestle, and it's very difficult for them. So that is massive uncertainty. But if you are in a camp that could raise prices with your customers still being happy with your product and doing what they're doing before, then I think that is one of our criteria to define a great businesses in this context.
Interesting, but would you expect, Peter, I bet you have a view on this, would you expect us to be moving into a more inflationary environment going forward? And Bank of England said they expect inflation here to go up to 4% or so, but still transitory, of course, and in the US it's higher already, and that always has an effect on markets, inflation going above 4 or 5%.
I think people have been forecasting inflation for 20 years, and it hasn't happened.
But it is happening.
A little bit. I think the worry is whether they will combat inflation by putting up interest rates. At the moment, they haven't done that, and that there are certain businesses that would struggle under those circumstances. One could argue a lot of the businesses that would struggle under raised interest rates, possibly it wouldn't be a problem if they did have their demise because it's low interest rates that are propping them up. But I don't feel strongly that inflation's really going to come into the marketplace. I could be wrong, I could be proved wrong, but I'm not very nervous about inflation, and I'm not worried about inflation as far as the performance of the fund is concerned.
And I suppose the place to be worried, Stephen, if you were, would be with the labour shortage in the US and wages going up. Are there any companies in the portfolio that might be affected by that?
We probably don't have any companies that would be infected. I mean, obviously, Amazon is, they employ over 1 million people in the US, and they would be paying high wages. But given that they have either digitized automated a lot of the things that they do, I mean, the pricing remains very competitive. So I think Amazon, if you look back over the last few years, I think it was back in 2018 or 19 before this pandemic started, they started raising wages for the workers. And obviously, if you are Walmart, which is the biggest player in the US retail market, like they would be forced to do the same. Otherwise, Amazon would be attracting all this talent. But the reason that Amazon can afford to pay people more money is because the business in itself is very scalable. Yeah, exactly.
Okay. Right, shall we move on and look at some of the specifics? One of the questions that has come in from a lot of your investors is about Salesforce, which was previously one of your, I think, favourite companies in the top 10, etc., and now it's not your favourite anymore at all. What's happened there?
So basically, Salesforce, the simple story is the market leader in customer data software business, and with a lot of people shopping online, company want to collect the data and know more about their customers. So we like Salesforce on that note. And I mean, the management team, Benioff, has been great since he founded the company 20 years ago. I think it really comes to the self-discipline or how we think about companies in the context of a high conviction portfolio. I think the valuation has become much less attractive, if not expensive. I mean, it's done extremely well if you look at the shares. Secondly, that's maybe like a bit of thesis violation that they have been making quite large acquisitions to date. I mean, this time last year they have acquired Slack, which is one of the to communicate for professional workers for over 20-something billion. I mean, that's a lot of money. And the way that we see it is they do want to compete with Microsoft, which is about $2 trillion company, but Salesforce is only a few hundred billion. And one way for them to do it is continue to make larger and larger acquisitions, and a lot of these acquisitions are actually not profitable to start with, or not highly profitable. So I think in terms of how we define high quality businesses, the return on investor capital profile for Salesforce is going to deteriorate from here. And last but not least, I mean, we constantly look for new ideas, and we have got some in the fund, and if we feel that the new ideas is worth a place in the fund, then something have to go. And Salesforce was one of those that we have held for a long time, and we no longer like it as much as before.
Okay, let me just take you back.
I was
Sorry,
just gonna
carry on,
add,
Peter. Yes.
one thing I've noticed that all the time I'm involved with markets, investments and everything, very, very few businesses make a good job of acquisitions. They tend to pay too much, and the business, when they bought it, isn't really worth what they thought it was. And we see that all the time. And I've never liked companies that are on an acquisitive route.
Okay, that's interesting. Can I just take you back then to one thing that you said, and either of you might have the answer to this. You said that Salesforce was beginning to look expensive, beginning to look overvalued. What metrics are you using for that? When you say something is overvalued, what do you mean?
So we do for any company that we have in the fund, we build a financial model to make forecasts over the next few years in terms of the free cash flow they can generate. And obviously, if you take into the stock-based compensation, if you adjust for the potential M&A they might do, whatever, then the free cash flow metrics adjusted for that would be the metrics that we refer to when we say something is expensive or not expensive. But one thing I just want to add on at the same time is you need to adjust for the quality of the business, because obviously you would have some you have some low quality businesses trading at a very high free cash flow yield, but then there's no growth. There's probably not the market leader in that industry. And then on the other hand, you might have Microsoft or Adobe trading at a premium to those businesses, but then the quality of the business is superior. So I think you need to adjust for that rather than just look at the absolute term. So I think as far as Salesforce is concerned, I think it's a great company, but it's probably not as well entrenched as, let's say, Microsoft or Adobe, because they do have other competitors. Like Microsoft does have a product that compete with Salesforce, for example.
Okay, well, let's talk about Adobe a bit more then. One of the questions that has come in is that, it's a great company, but some of your investors think it's beginning to look a little overvalued, and asking whether you will be thinking about trimming that position as well.
Yeah, I think the short answer is we do partly agree with that. So we have actually been reducing our holding a little bit. I mean, still it's a top 10 holding in the fund since we started. And I think for a company like Adobe, it's all about looking at the short term versus the medium term. I think over the medium term is a great company. You just want to hold it. But we, as a fund manager, we probably want to be opportunistic, because we have other names in the fund that are probably even more attractive. We want to redeploy some of the capital. But I think one thing that people might have underestimated about Adobe is when you're looking over the shorter term period, let's say over the next 1 to 2 years, okay, maybe some metrics is trading, it's probably telling you that it's expensive, but if you look at the medium term, it's actually still a very high quality business. It's growing sensibly, the margin is very high, it's net cash, and there's no competitor in that space. So you do want to hold Adobe for a long time. But what you do in the short term, I think it goes back to the question that you asked earlier.
Yes, you'll trim it, but you'll keep it.
Yep.
Okay. Now, you said that there are some new ideas, and I always love the way you say that you're looking for the most beautiful companies in the world. So what are these new ideas? What are these new beautiful companies that you're bringing in?
Yeah, so we have got one new idea recently, which is NVIDIA. And obviously, I think a lot of people would be familiar with NVIDIA if you have been if you are gamers, like in the gaming space, if you are into crypto, in the crypto mining space. But then that is not the reason why we like NVIDIA. NVIDIA is all about what's going to happen in the next 5 years. And then we will be talking about a lot of data, explosion of data has been collected on us, on the super cloud, on the cloud, and it needs to be analyzed. So if you have maybe like a Google Home at your place, or maybe Alexa, there's a lot of recommendation that's personalized to you. And NVIDIA's chips, which is graphic chips versus CPU, has been recognized to be more suited to perform specific tasks, to do the recommendation for you versus me, etc., etc. So I think with the penetration of 5G coming, with a lot of data, artificial intelligence, NVIDIA would do extremely well in the next 5 years. And I think that's a good example that we don't need to worry about anything in terms of macro uncertainty, even you talk about inflation, rising interest rate, they are going to win much bigger share in the next 5 years.
I'm not sure that's made me feel particularly comfortable, to be honest. All that data analysis. Is there any other companies coming in? Anything else new and interesting?
Yeah, I think we do have some names that we're working on, which we normally don't share that if they're not in the top 10, but yeah, you maybe
okay,
for the
so
next
we'll
one.
find out in
yeah,
time. Next Q&A, we'll find out. Okay, now let's move on to something that a lot of people have been asking about, whether you might ever in the fund get any exposure to cryptocurrencies. Now, I'm guessing, Peter, that you've got a big cryptocurrency portfolio of your own, your little Bitcoin, little Ethereum. Would that ever move into the fund?
Well, a lot of people might be surprised, but I am actually quite a fan of cryptocurrencies. I think the idea is extremely good, and it's mainly because I don't think we can trust any governments in the world with our currencies. And these are not affected by governments whatsoever. It's sort of like gold in a way. But in second part of the answer is, do I hold any? No. And so, whilst I think they're a good idea, why do I not hold them? It's because they are really quite complex to hold. And to be safe, the security of them is, I can't find any way that I could be certain of the security. Perhaps it's because I don't understand the technology behind them, but that's why I haven't bought any. And also, it's not easy to buy big chunks of these things, and I mean it is fairly common knowledge that I'm quite a wealthy man, and so I would only want to buy them if I could get a decent slug, and I can't be bothered with small amounts and all the messing about for the security and how to hold them, etc., etc. I mean, it'd be interesting because people are going to be able to hold them through PayPal, and that might be an interesting way to hold them. But again, it's only small amounts, but that will be an interesting way to hold it. But it is a very alternative investment, but it is bound to be extremely volatile. So any time you can halve and double your money. And if people are happy with that volatility, then it's an interesting addition to anyone's portfolio.
So you can understand why people would buy cryptocurrencies if they didn't trust government financial systems, but you can't quite trust cryptocurrency systems either.
It's the security of how you hold them that worries me.
Stephen, can you imagine it?
Not for this fund, so we will not, or we cannot invest in crypto directly for the LF Dual Growth Fund. But I think I think my view might differ from Peter slightly. Is I'm really interested not in crypto but in the blockchain technology behind that. And if I look back during 1990s or early 2000, we will be talking about the rise of internet, and I'm sure some of you might remember that we will be talking about internet browser like Netscape, Internet Explorer. We'll be talking like Cisco, some telecom company building infrastructure. But now, who are the biggest company? I mean, Google was the 7th search engine that launched in early 2000. It wasn't even the first, and where's everyone else? And obviously that at that time there wasn't any Facebook, there wasn't WhatsApp, there wasn't like a lot of stuff that we are now really engaged on our smartphone through the internet. And I think the blockchain technology is the really interesting part, but then at the moment it's still such an early stage. But then I think in time we'll definitely be keen on companies who can truly embrace the blockchain technology in terms of taking the business further. And I think crypto is just one of the ways, of the few ways that you can get exposure to, but it might not be the answer.
So how do you see good companies using blockchain to improve their businesses? How would that work?
Yeah, I think especially, I think it's already started maybe in a small way. I think in a lot of financial services, I think if you look at some stock exchanges, some payment that the payment network, like even like Mastercard and Visa, they have been invested in some companies that are developing this kind of technology. I think in time, if they can embrace that as part of that business model, I mean, it would save them costs, it would make it more efficient, it would be real time, everything got authenticated without external parties to verify certain transactions. I think that would make it really powerful. But I think we're at an early stage of that cycle.
Okay. Now, anything that we ask about crypto has to sort of slightly move on to a question about ESG, environment, social and governance issues surrounding the fund. And this is the big talking point in the financial industry at the moment. How responsible is the fund and how do you deal with all these issues? Now, there's no, as far as I can see, specific policy that you have with this fund. Is there an ESG sort of overlay behind the stock picking? Peter, do you want to answer that, or shall I just skip straight to Stephen on that?
It's a difficult one. Investors want to make the most of their money, and many investors are reluctant to embrace things within their investments that could be water down the effect. But I think the world right now is in a place where people are more caring, and clearly there is an enormous amount of momentum for this sort of thing. So we have to be aware that where we're investing, that the companies we're investing in don't get in trouble for not being caring in one way or another, and that I think is as far as you can go. You can't totally say that this fund ticks every single box in that area, and we were the last people to say we could, but we are very, very caring in how we choose companies, and we hope the companies that we choose are equally caring, and if we thought there was anything remiss, we wouldn't hold such a company.
Fair enough. Anything to add to that, Steve?
Yeah, I think to us, I think ESG, we see ESG as, we define ESG as like a risk factors to how we see a company, whether it's high quality or low quality. And I think if you work the other way around, like if your business is causing harm to the environment, if you're selling product that's harming people's health, and if you have a company with really weak corporate governance, surely it's not going to tick the boxes that how we define high quality businesses. I think so this is not a high impact fund, but any companies within the fund would have to be able to demonstrate that they're not in that camp, which it would be, I don't know whether you call it ESG friendly or at least not unfriendly to ESG. But I think that is one big thing about what's happening in the market now. I think there's a lot of funds out there that might be starting from an other angle. Basically, they will be looking out for companies that are doing this. But then I think as far as investment context is concerned, I think ultimately you need to do better than the market. And I think some of the funds out there might be going down the wrong track. Like, sure, you take all the boxes, but is the company overvalued? Are they going to deliver better return for shareholders over the medium term? I think that is still yet to be seen.
Okay, so in a nutshell, if you're choosing quality companies, they should in general be fulfilling the kind of ESG criteria most people would be interested in anyway. It's an automatic side effect of the way that
Correct.
you pick stocks in the first place.
Very much so.
Okay, brilliant. Okay, now, one of the things that everyone is asking is, you've done so well with this fund. Will there be another one? Might there be a smaller companies fund, or probably not a specific ESG fund? We've just discussed that, but will there be, I don't know, a UK income fund? Will there be a trust? Will there be, what next, Peter? What next?
We debate it a lot, and we think at this stage we're going to put all our efforts into this one fund. That's what we want to run, a truly global fund, even though arguably most of the investments are in America, but the American stock market is the one with the most opportunity. And I don't think we want to put any effort anywhere else. We discuss what other funds we could have in the future. We think we might have an investment trust one day, but it will be similar to this fund, but it will be smaller companies, which we think is an investment trust is a better place to hold smaller companies. But right now, until this fund gets to 3 or 4 billion in size, all our efforts will go into that one fund.
3 or 4 billion, ambitious.
Sorry?
Ambitious.
Oh, we want to be bigger than that.
How big do you want to be, Peter?
Well, we want it to be a size. We don't want it to be a size above where we can manage it effectively. But this fund, the investments we have in this fund, if somebody gave us $1 billion tomorrow, we could get that in the market almost straight away.
Yeah.
There is that sort of liquidity. And on the other hand, if everybody wanted their money back tomorrow, we could liquidate it tomorrow. It is that liquid. So right now, it's a very manageable fund, and it would be at a much higher value. But we think it's important that we focus on this one fund. That's what we're being paid for by our investors, and that's what we intend to do.
Okay, you've partially answered the next question that someone has asked, which is about unquoted investments. You know, because some even very large funds have had huge success with unlisted investments, because obviously you don't have to be listed to be big these days. There are huge private companies which obviously you don't currently have access to the way you invest. Can you see a future where there might be large unquoted companies in the fund?
Yeah, it will not be for this fund, because I think, as Peter already pointed out, that this is a highly liquid fund. I mean, people can be coming in today and taking their cash out tomorrow, and we would remain very much focused in the large cap area. And I think one statistic I would give is, if you look through the average market cap of our holdings in the fund as of today, they are over £100 billion worth in terms of the market cap. And obviously then you have the Facebook and the Microsoft is like $2 trillion. So they're really big companies, and we want to keep the fund in this manner. I think in time, if we are ready to consider maybe like a closed-ended fund such as an investment trust, then maybe we'll explore the unquoted, but not for this fund.
Okay, so there is, a lot of other funds are getting a lot of growth from this area, but that's a piece of growth that you're happy to set aside because you're happy with where you are.
Yes, I think it's just the mandates that we took upon like 4 years ago. I think we set out to focus on developed markets. We've set out to focus on a large cap space. We think that this is how we can do well. But the other thing is, obviously, if I give you another statistic, that we set out to do better than the market, like by, let's say, over 5% per annum over the medium term. And if we can replicate our strategy into smaller companies, obviously that target would be higher, because in a smaller company it's less well researched, and if we can actually add any value, that the upside potential should be more. But not for this fund. This fund is really for people who are interested in a large cap and with a lot of liquidity in the fund.
How big is the team at the moment? How many people have you got?
There's 6 of us in the investment team.
6 of you, and the maximum holdings in the fund is?
This is a UCITS fund, so we're subjected to 5, 10, 40, so less than 10%.
Okay, thank you. Right, now we've got lots of questions coming in. You ready? Okay, new questions. Right, Peter, this one's directed at you.
Let's hope I can
It's not
answer
mastermind,
it.
it's all
Let's
right.
hope I can answer it.
Why should people invest in this fund as opposed to the more established names in possibly a similar space, such as Lindsell Train, Fundsmith, etc.? I mean, I think you've already largely answered that one, but anything else?
I think an old person like me, 75 next week, can answer that question. One thing that people should be very, very aware of is the age of the investment team. And Blue Whale's investment team is very young. Stephen's the oldest. They're going to be around. And a lot of established funds in the marketplace, the fund managers are close to retirement. And so who are you going to get next? I remember the furore when Anthony Bolton retired from Fidelity. You're not thinking of retiring soon, are you, Stephen? but that is an important thing. And the trouble is, if somebody does retire and you have a large holding in the fund, you have a very difficult decision, because if you sell it, you're going to have to pay capital gains tax. And the beauty about being in a collective investment like this, the fund doesn't pay capital gains tax. You only pay capital gain tax when you sell it. And if suddenly you have a decision because the fund manager's retired. So I'm a great believer in investing, providing the fund manager are proven, with young fund managers. Young people still hungry and going to be around for many years to look after the money for you.
Interesting. Well, I hope that most of your investors will hold the fund in their ISA or their SIP, so they never have to worry about capital gains.
Of course,
but
of course,
it's a good point. Yeah.
Yes. So obviously, if it's in a tax-free environment, but you know, I suspect most of the money in the fund is not in ISAs and SIPs.
Anything to add? Stephen, why
no.
people should hold this fund over everything else in the market?
I think ultimately, I have enormous respect for the other two competitors, and I think there's a lot of good things that they have done over the last 10 years. And what we're trying to achieve here is we are very competitive. We want to do a bit better. We're a bit younger, we're a bit more hunger. We are highly incentivized to prove ourselves now, hopefully in the next 5 years, that we'll be around for about 10 years in 5 years' time. And I think there's just a lot of things. If you do happen to come to see us, you would feel the energy within the team, like everyone is really working hard, and we just try to do a bit better. So hopefully the performance will speak for itself.
Okay, well, I think we've answered the next question, which is again to you, Peter, and it's about the team being young. Are you worried that there's a lack of experience there? There's obviously a lot of enthusiasm, but is there a lack of experience that would concern you? And that's particularly the case, actually. There's a question just after this about, well, the last 4 years have gone brilliantly. This team has not been exposed to a full cycle. So are we worried about lack of experience through the ups and downs of a full market cycle?
I think Stephen has been very, very good at reading markets. But if there is an upheaval in the stock market, the most experienced team in the world can't do anything about it. It's instant. The market makers marks the stocks down instantly. There's nothing you can do about it. The most important thing is to make sure you've got companies that will be resilient in such circumstances. But I've no worries about the youth of the team. In fact, I think that's mainly positive.
Okay, good. Okay, here's another question from Michelle, and it's on a sort of similar area, but not quite the same thing. Are you happy having such large sums of money invested in a company which you don't have explicit day-to-day involvement in?
I'm very, very happy.
I thought that would be the answer.
Yes,
I didn't think there was another answer there.
No, just
very
ask.
happy. And of course, you do have quite a lot of involvement, don't you? You're here now, talking about it. Obviously, very familiar with everything about it.
We talk a lot. We haven't for the we've only talked on the telephone and by Zoom for the last 18 months. But of course, now there's more mobility because COVID seems to be on the wane. I do enjoy meeting the team, and the vibrance and atmosphere there is just fantastic. And it's been a joy, really, being involved with this business.
And has anything surprised you? This is a question from, actually, we haven't got a name on this question. Are you satisfied by the performance over the last 4 years? I'm guessing yes. But the second part of the question is anything about it surprised you? Anything about the way the fund has gone surprised you?
I have to be honest, I thought Stephen was quite optimistic on what he was expecting to do. I did say, Stephen, I think you ought to set your sights a little lower than that. But actually he's achieved it, so that has surprised me in a way, yes.
Okay, so it's a good surprise.
Yes, I'm surprised on the upside.
No bad surprises here at all yet. Right, another one, and this is really for you, Stephen, I think. Apart from technology businesses, what sectors really fit your criteria for growth opportunity? We've slightly answered that over the last half hour or so. But
yeah, we do have some other sectors outside of the, on the high-level technology names, such as like medical equipment companies. Like we have Stryker in the fund. They're American businesses doing really well. And then we do have some luxury names in the fund as well, LVMH and Kering. They're not doing that well at the moment because of what's happening in China. But then we do cover also at the same time consumer staples company. But I think the funny thing about when people talk about technology is like if you go through the GICS definition, which is what you see on our fact sheet, MasterCard, Visa and PayPal are defined as technology. But then to us, they are financial services rather than technology. So I think it seems like the line to be drawn, whether you're technology businesses or not, is not very clear at the moment. But the way that we see it is like we have this one lens. We just want to invest in great businesses. We don't really care whether you are a technology business or non-technology. But I think as we stand here now, given what happened over the last 18 months, you would expect that most companies that are still doing pretty well would have some sort of technology element in it.
So where these I go back to the luxury goods companies not doing very well at the moment because there's prosperity issues in China, etc. But how would you expect that to turn around?
Where's
the growth?
Yeah, this is a very interesting question because we have a very small position in these two companies now. It's like in total, I think they're just about 3% of the fund in total, and we have been reducing the position just before all this development started. And I think the way that we think about this is a bit. You have to put on the lens of how the financial market or stock market operates. Mm-hmm. Because if you remember back in March or February last year in Q1 2020, COVID just started in developed market in the UK, in Europe, and in the US. The stock market crashed. But in Q2, when we had the lockdown, the stock market recovered quite quickly. So basically, if you look at the share price reaction from these companies, they are already down about maybe 20%. And I think it's likely that if they fall by another 15 to 20%, it's actually a very interesting entry point because the valuation would become very attractive. And obviously, you would be thinking, oh yes, the Chinese consumer is probably going to buy less, but the luxury brands, the product this company produce cannot be replicated anywhere else. At some point, it's going to come back, and obviously, there's many ways to buy these kind of goods. Even in China now, you can go to, they have a lot of domestic selling that allow people to buy luxury goods, and so I think it's how you think about it. For us, I think they're really high quality businesses. Secondly, valuation is key. I think we might be getting closer than what the market might expect.
Do you agree with that?
Yeah, people are back buying luxury goods. in my taxi here, past lots of shops, and they all look to be doing rather well. And we went out for supper last night in London into what is really quite an expensive restaurant, and it was full at 7 o'clock. Incredible, really. Yeah. And so people are back, the consumer's back, and but there are a lot of factors in that area. But we've made money out of the luxury good investments we've made. Yes.
There's a question about MasterCard and Visa, which you just mentioned, which asks, do you worry about their model being displaced by crypto or blockchain? These are businesses that have obviously had a great pandemic, what with the soon-to-be end of cash. But is there a threat to their business the next stage along the technology line?
Yeah, I think we're not worried about crypto being a disruptor to those businesses. I think that many potential disruptors, like buy now, pay later. We can talk about that if our audience is interested. But I think as far as crypto is concerned, if you look at what Visa and MasterCard have been doing over the last few years, they actually have invested in some of these companies that are either crypto platform or some sort of money laundering services to detect whether there's the wrong trade in the crypto market. So these companies are actually quite on top of what's going on. At some point, you have to expect if crypto were to become a proper a trading currency on a day-to-day basis, they would need to be regulated. Who is better to provide the service to ensure that it's highly regulated and transparent? MasterCard and Visa would be there, and I think unlikely they would be the disruptor to their business model.
And holding both of them?
We do have both of them.
Competitors, but...
Yeah, they are kind of competitors, but it's there's only two players in the market outside of China. And the other thing is quite interesting is if you look at Visa, they're really the market leader in the US, and MasterCard is a smaller player, but then MasterCard is a better, probably like a more advanced company outside of the US and trying to take market share across the board. And I think both of them are great businesses.
Okay. Well, actually, we do have a question now on buy now, pay later. Is that a threat to these businesses?
As we stand today, it's not a threat yet, because if you look at the data, about over 50% of the transaction to start with through buy now and pay later will be done through a debit card. Not directly transferred from banks. So if you're done through from a credit card, which would be either owned by and powered by Visa or MasterCard, they get paid for that. And actually they get paid more because you are going to do it over the next 4 quarters, four times a year rather than a one-off transaction. So at the moment they are actually benefiting, but there's always a risk in time that maybe they would be displaced. But we're not seeing that yet.
And what would you buy to insure yourself against that?
This is the interesting thing about why we think that we have added some value over the last few years is there's never an ending point. Like we could do all the research on a company, and then we would then determine this company is a great business, is a disruptor. But at some point, that might be another disruptor coming into the industry to disrupt the business. And I think the one thing that we can ensure is we stay on top of what's going on. I mean, we have done some work going into analyzing what buy now, pay later means, looking at different companies, how much money they're making. I mean, most of these companies are not making any money. They need to get a scale, but it might not be easy. And the way to see it is they have extended credit to people who probably couldn't afford a credit card to start with. I don't think any of us here would be using buy now, pay later, right? So whether they are going to make their money back in time, that is still questionable. So we stay on top of all these. I mean, there's 6 of us, and the other thing which is quite interesting is that, like, if you look at most of the top 10 holdings in the fund, that we do know this company. I mean, we are user of Adobe, we are user of Salesforce, we are user of Microsoft, we are user of Amazon, Google. I mean, once you are on top of this company, you can actually get the research to a level that you can understand, is that a disruption or not disruption? But you do need to follow the development very closely rather than just say, forget about that for 5 years and come back.
Yeah. Stephen, there's another question for you, which is sort of similar to some things we've been talking about, which is, what is the non-US company that most excites you? You can answer that if you like, Peter.
No, thank you.
It is very difficult. I mean, we do have one that, I mean, we did have the luxury names, which it's not very exciting at the moment. We do have ASML in the fund, which is in the semi-cap space, and I mean, obviously, I think people would know this. They produce this really high-end EUV machine. So if you have the latest latest iPhone from Apple, they would have these chips which is really powerful that can only be manufactured using the machine. And I think we are now sitting here, we are in some sort of like a super cycle in the semiconductor space. A lot of countries are talking about, oh yeah, given that the geopolitical risk in Asia about Taiwan, etc., they want to build up their own fabs in Europe, in the US, and then they would need to buy more of this machine to produce the chips. So I think ASM is probably one of the few companies that is very exciting at the moment. I mean, we do have other names which is a bit smaller in the market, but I think the one thing is a bit unfortunate that in Europe, typically most companies are not digital heavy, or maybe they're not technology heavy in terms of, like, a lot of businesses are quite traditional. They're quite cyclical. I mean, if you look at the UK stock market, I think we got asked about this many times. I mean, you will be talking about Deliveroo, maybe exciting, but we probably don't see that as a high quality business. I'm not sure whether anyone should be investing in them in the first place. And then we have the oil and gas, we have some telecom, we have the commodities. I mean, we're not excited by any of those. So I think we struggle. We struggle in Europe.
So there's nothing, for example, in the energy sector that excites you?
No, we are not. We are not interested because I think they're just highly cyclical as an industry. I mean, at the moment they're doing extremely well. But then if you look at what happened last year, I think they probably have a period of doing very badly when the market crashed.
So when you look at the large companies in the UK, you can't see a single thing that makes you think, oh, we like to hold that.
Not at the moment. I think, not at the moment.
Peter?
Yeah, we've lots of irons in the fire and lots of ideas, but until they tick all the boxes that we need, we're not going to go into a sector or an economy purely for diversification. We've got to find great companies that fit all the more important long-term investment criteria, and we're quite brutal.
Can I just add one point on that? So despite the fact that we are, by listing, that we're 70% exposed to US listed companies, a lot of these companies are global businesses. So what we really do as investment managers is we look through the underlying revenue stream, like where do they sell their product, like how do they make money. And if you go through the portfolio on a weighted basis, we have actually less than 50% exposure to the US economy. And then we actually have about 20% in Asia Pacific and including emerging markets. But we don't invest in those companies directly because the lower quality stuff that we talked about earlier. But then if you invest in a company like, I don't know, like Adobe or even like some of the names, I mean, they will be selling to the rest of the world. So they're global companies, but they just happen to be American companies as we speak.
Okay, well, that answers a question that's come in quite recently. Would you be looking to invest directly in Asian markets such as India, Vietnam, and Japan? And the answer, I suppose, is no, not really, because you're getting all the exposure you need by being invested in these big American companies.
Correct. Just to note a small point that we do have an investment in a Japanese company, Nintendo. And I mean, we like it for, I mean, I can go through the thesis, but we do have one holding in Japan, which is Nintendo.
A few words on Nintendo would be great. I mean, that's a company, my stockbroking days in Japan 20 years ago, I remember telling people about Nintendo relentlessly, about its great future.
Very forward-looking then. I personally like India, but I think you've got to be an insider to invest in India. We do not have that ability to look at Indian companies, really.
Fair enough. And Nintendo?
Yeah, the reason that we...
I haven't a clue. I wouldn't have to start. I wouldn't have to switch it on.
I always think of you as a bit of a gamer.
Yeah, we like Nintendo for 3 reasons. I mean, the shares has not done well recently, which I will come back to that. And I think on a high level that Nintendo have a lot of IP, so they have a lot of games that they are owned by them, like Mario, like Zelda, like Pokemon, etc. And then the other thing is they have been quite late in terms of transforming the business to become more digital. So in the past, that you will be going to a store to buy your game, pay 50 quid, but now you can actually download the game straight directly from your console. And thirdly, I think it's the most important is what Nintendo is trying to do is they're trying to make the latest console, which is Switch, that you can do that you can play the games into some sort of like an iPhone cycle. So historically, if you look at Nintendo, it's not a great company because every few years they come up with a new console and then it's completely different. You have to rewrite the games, you have to rebuild the audience, etc. But now the iteration that they're doing is probably quite incremental, and then you can leverage up the audience that you already built up over time, and I think Nintendo should do pretty well. And I think if you look at the valuation of Nintendo as we see it here today, is trading at a level that we feel that is extremely attractive if you believe the thesis that the work that we have done, and hopefully in time it will, yeah.
We're probably a bit too soon.
The
market hasn't noticed yet, but when the market notices.
Yeah, well, in our next Q&A, we'll talk about your favourite games and that
kind
of thing.
Yes, okay, I'll
You'll
buy
practice
one
in
just
between.
for the hell of it. Right. I think not.
I think we have to leave it there. That's all we have time for. But thank you so much, Peter, Stephen, and thank you all very much for joining us today.